A private asset manager most retail investors have never heard of just agreed to pay $7.3 billion for one of Europe's largest budget airlines. And the market's reaction was immediate and unambiguous. EasyJet shares jumped 10% in a single session. That single number tells you something important. A 10% gap between where a stock was trading and where a sophisticated buyer is willing to transact is not noise. It is the market admitting it had been wrong about something. The question worth answering today is, wrong about what exactly? And what does Castlelake know that the public market was not pricing in? Castlelake is not a household name the way Blackstone or KKR is, and that is worth paying attention to on its own. Founded in 2005, Castlelake specializes in asset-based private credit and opportunistic investing, meaning they look for situations where hard, tangible assets are either mispriced or underleveraged relative to their long-term cash generation potential. Aviation has always been interesting to this style of investor. Aircraft are among the most liquid hard assets in the world. They depreciate on a known schedule. They generate predictable lease revenue. And in the case of a going concern airline like EasyJet, they sit inside a network with genuine route density and brand recognition across Europe. The timing here is not random. Through the first half of 2026, private credit and alternative asset managers have been accelerating their push into industries that generate durable, contracted cash flows. As public market valuations in certain sectors have compressed under persistent interest rate pressure, the gap between private buyers' willingness to pay and where public markets are clearing has widened. EasyJet, prior to this announcement, had been trading at multiples that reflected considerable skepticism. Fuel cost, volatility, labor disputes, and the structural question of whether low-cost carriers can hold pricing power as competition intensifies. Castlelake's $7.3 billion bid is an explicit statement that they believe that skepticism was overdone. Specifically, they are betting that EasyJet's asset base, its slots, its fleet, its route network, is worth more under private ownership, where capital allocation decisions don't have to satisfy quarterly earnings calls. The actionable insight here is straightforward. When a specialist asset-based investor pays a 10% premium to take a business private, the first thing you should ask is what the constraints of public ownership were costing that business. That answer usually tells you more than the headline price. Let's be precise about what a 10% single-session move means in this context, because it is easy to read it as simply good news. It is more specific than that. In an efficient market, a stock price is supposed to reflect the consensus, probability-weighted expectation of all future outcomes. When a credible buyer closes a transaction at a 10% premium to the prior close, it means the market had been assigning meaningful probability to scenarios where EasyJet either remained trapped in a lower growth equilibrium, faced structural pressure it could not escape, or simply never attracted the kind of capital reallocation that would unlock its asset value. The fact that the stock moved 10% on this news, not 2%, not 4%, but 10%, is a signal that this deal was not widely anticipated. That matters because it tells you the market had genuinely discounted EasyJet's M&A optionality to near zero. Budget airline stocks in Europe have been under pressure for legitimate reasons: fuel hedging complexity, slot allocation battles, the ongoing tension between keeping fares low enough to fill planes and high enough to generate real margins. Investors had been pricing EasyJet as a company navigating those headwinds alone. Now, here is the part worth sitting with. The 10% move is the floor of the value gap, not the ceiling. Castlelake is not paying a 10% premium because they think the business is worth exactly 10% more than it was yesterday. They are paying it because they believe the private market value, inclusive of operational changes, capital structure optimization, and potential asset monetization, is materially higher. This is not financial advice, but understanding that distinction between headline premium and strategic valuation is fundamental to how sophisticated investors read M&A announcements. The pop is the public market catching up to a private market conclusion that had already been reached behind closed doors. EasyJet is not an isolated event. It fits cleanly into a pattern that has been accelerating through 2026. Private capital, specifically asset-focused managers like Castlelake, moving into public companies that own substantial hard assets but are constrained by the demands of public market reporting cycles and the short-termism that comes with them. Consider what public ownership costs an operationally complex business. Quarterly earnings pressure discourages the kind of multi-year fleet optimization or route restructuring that might reduce earnings in years 1 and 2 before generating significant returns in years 4 and 5. Public investors, particularly in a rate environment where there are alternatives, are not always willing to wait. Private owners are. That asymmetry in time horizon is one of the most durable edges in private equity and private credit. Not superior intelligence, just a longer clock. The aviation sector is particularly exposed to this dynamic right now. Slot portfolios at major European airports are genuinely scarce assets. They do not depreciate. They become more valuable as cities grow and regulatory barriers to new airport construction remain high. A private owner of EasyJet's slot portfolio at airports like Gatwick and Amsterdam has a different set of strategic options than a public company that needs to justify every capital decision to quarterly analysts. The broader signal here is worth internalizing. When you see a pattern of private capital bidding for asset-heavy, cash-flow-visible public companies at premiums, it is worth asking which sectors still have this gap open. Infrastructure, logistics, certain corners of energy, the same structural logic applies. The Castlelake EasyJet deal is one data point in a larger thesis about where private capital believes public markets are still systematically undervaluing the optionality embedded in hard assets. Watch that list. It tends to be predictive. We opened with a question. What did Castlelake know that the public market was not pricing in? The answer is not a secret. It is a framework. Asset-based private investors with long-time horizons consistently find value in public companies constrained by short-term reporting demands. EasyJet is the latest example. The follow-up question worth exploring. Which other asset-heavy European public companies are sitting in that same gap right now? We are going to look at that directly in the next video. Subscribe so you don't miss it.